What if you could finally stop trading against the market and start trading with the smart money? In this video, I'm going to show you 3 powerful smart money trading strategies that institutions use every single day. Strategies that go far beyond basic support and resistance. You'll learn how to spot and trade the power of 3 pattern, used to trap retail traders and create explosive moves. RSI divergence combined with liquidity sweeps, a deadly combo for catching reversals early. And the breaker block, a hidden level most traders overlook but smart money uses to re-enter the market with precision. Whether you're trading forex, crypto, stocks, or indices, these strategies will help you think and trade like the pros. Let's kick things off with the first strategy, and it's a big one. It's called the power of 3, and it's one of the most effective smart money concepts out there. This strategy breaks down price action into 3 distinct phases: accumulation, manipulation, and expansion. It's a blueprint for how institutional traders operate. They build their positions, trap retail traders, and then launch price in their intended direction. Understanding these phases helps you avoid fakeouts and trade in sync with the smart money, not against it. Let's break down each phase so you know exactly what to look for. Consolidation. During the consolidation phase, the market moves sideways in a tight range, giving the illusion that there's no clear direction. But behind the scenes, smart money is quietly accumulating or distributing positions. This calm, range-bound action is the foundation for the bigger move that's about to unfold. Manipulation. This is where the trap is set. The market fakes a breakout above or below the range to trigger stop losses and lure retail traders into bad positions. It's a classic liquidity grab. Smart money hunts for orders resting above resistance or below support before reversing the move. This phase clears the board and sets up the real direction that follows. Liquidity sweep. A liquidity sweep happens when price breaks below a key support level, only to snap back into the range moments later. This false breakout is no accident. It's a move designed to trigger stop losses and trap breakout traders. Once smart money collects enough liquidity, the market quickly shifts direction. That's the start of the acceleration phase, the real move. As smart money traders, our goal is to catch this phase, entering right after the stop hunt, when the momentum is fueled by trapped traders exiting their positions. Acceleration. This is where the real move begins. After triggering stop losses during the liquidity sweep, smart money unleashes momentum in the opposite direction. Price moves rapidly, leaving retail traders who fell for the trap behind. This is the ideal moment to enter, right after the manipulation, so we can ride the wave created by smart money and capitalize on the momentum that follows. The power of 3 is built on 3 phases: consolidation, manipulation, and acceleration. This pattern is a clear blueprint of how smart money moves the market. First by building positions, then by trapping traders, and finally by driving price with strong momentum. If you can recognize these phases and time your entries during the acceleration phase, you'll be trading alongside the smart money, not against it, and positioning yourself to catch high probability moves. Let's look at how to actually trade the power of 3 in both bullish and bearish markets. When the market is in an uptrend, smart money will eventually begin taking profits. This leads to a distribution phase, where price starts moving sideways in a tight range. Here's how to trade it. First, wait for a clear range to form. This signals that institutions are offloading their positions. Then comes the liquidity sweep, a false breakout above the range that grabs stop losses. Once price returns back inside the range, that's your signal. Enter at the close of the candle that re-enters the range. Place your stop loss above the recent high. Set your target at the next key support level. This allows you to catch the acceleration phase, also called the markdown, where price drops rapidly after the trap. In a downtrend, smart money is looking to buy at discounted prices. This begins with the accumulation phase, where price starts to consolidate in a range. Here's how to catch the upside move. Watch for the range to form. This is smart money building long positions. Then, wait for the liquidity sweep, a false move below support to trigger stop losses. Once price comes back into the range, that's your entry setup. Enter at the close of the candle that closes back inside the range. Set your stop loss below the recent low. Target the next key resistance level. This positions you to ride the acceleration phase, or the markup, as price surges higher after the trap. Now, let's break this down on a real chart so you can see exactly how the bearish power of 3 plays out. We start with an uptrend. Buyers are clearly in control, and price is making higher highs. But then the market starts to move sideways, forming a range. This is our first clue. At this point, price could either break higher and continue the trend or reverse completely. As smart money traders, we stay patient. We're waiting for a false breakout above the resistance, and that's exactly what we get. Price breaks above the range, grabs liquidity, then closes right